Good evening to everybody. Thank you for joining us. This is the Integrity 365 webinar on tax allowances, and it's one of a series of webinars that we are running. You can find our previous back catalogue on our website. Different topics covering topical items such as, for example, the trust registration process, which is a new introduction from HMRC this year. And there will be further webinars to follow, so do keep your eyes peeled. Today we are joined by Neal Groves, who is Head of Personal Tax at Beavis Morgan in London. Beavis Morgan are accountants and tax and business advisors, and Neal is an experienced tax advisor used to advising clients on how to be more tax efficient. What we plan to do today is remind you of some of the various tax allowances that are available and the benefits of planning ahead so that you can make the most of them. The webinar is going to be recorded, so you will be able to watch back if there is something you want to revisit. And of course, the webinar link will be available to those people that wanted to join us but weren't able to. One thing to say is that you can, if you do have any questions, use the chat function. We will be checking that, and there will be a question and answer session at the end of the webinar. So moving on, I'm just going to tell you a bit more about the various areas that we are going to cover. Now, the taxation world is very complex, and there is a lot more material than we can possibly cover in a single webinar. So the areas we're going to focus on are as follows. Firstly, income tax and the various allowances, of which there are many. Capital gains tax and the exemptions that apply and the planning opportunities that are available. Inheritance tax and the allowances and the gifting opportunities that are available, and other allowances, mainly focusing on HICEs and pensions. Now, we will try to bring these areas to life for you by using relevant examples, things that will perhaps look similar to your own personal situation. But of course, do be aware that nothing we say will be treated as personalised advice, and you should take advice if you've got any specific queries about your personal situation. I'm going to hand over to Neal now. He will take you through income tax and some of the associated allowances.
Hello, good evening, everybody. As Nick says, thank you for joining us. So I'm going to start by talking about income tax allowances. As you can see on the screen in front of you, there's various allowances which we're going to cover. And as we're all no doubt aware, there's a cost of living crisis at the moment, and with the costs of goods and services increasing and inflation tipped to peak at 11%, we should all make sure that we're making the best use of the allowances that are available to us. So I'm going to briefly outline some of the reliefs available and run through some examples to help. And hopefully you can then maximise the allowances and use them to your benefit. As Nick said, time does not permit us to go through every single possible scenario or every possible relief, but hopefully there'll be a few things you can highlight and will make you think. So if we start with the personal allowance, the general rule is that everyone is entitled to a tax-free personal allowance of £12,570. For most people, this is automatically applied to their earnings or their pensions via the PAYE system. So it's not something you would need to apply for, it's an automatic thing. If you're self-employed or you have perhaps rental income, then it would be applied via your annual tax return at the end of the year. One very important thing to note is that the personal allowance starts to be withdrawn when your taxable income goes above £100,000. And it's withdrawn by £1 for every £2 over £100,000 that your income goes. So by the time your income reaches £125,140, you have no entitlement to the personal allowance at all. This gives actually an effective rate of tax of 60% between 100,000 and 125,000, which is basically the 40% of tax and the tax effect of the withdrawal of the personal allowance. One slight word of warning here is, in my experience, looking at lots of people's tax affairs over the years, well, if they're employed, perhaps, and their income goes above 100,000, the PAYE system often gets the tax code wrong, and you'll be given allowance perhaps where you're not entitled to it. So just something to keep in the back of your mind when your income goes above £100,000, just keep an eye on your tax code or ask someone to help if you're not sure if it's correct, just to make sure that you're not left with a big tax liability at the end of the year. So having established that you lose your personal allowance when your income goes above 100,000, is there anything we can do about it? Well, the answer is yes. It is possible to make pension contributions, say, or charitable gift aid donations, which all count to reducing taxable income and reinstating some or all of the personal allowance. The slide we've got on the screen now is a very simple example of the effect on someone with income of £130,000 making a pension contribution of £20,000. So if we look on the left of the screen with no pension contributions, the personal allowance is completely withdrawn and the total tax payable, to simplify, we're ignoring NIC, is £44,460. Where on the second example, there's gross pension contributions of £20,000, which hopefully we all know, to get gross pension contributions of 20,000, you would only need to write a cheque out for £16,000. This gives adjusted income of £110,000 and reinstates some of the personal allowance, in this case £7,570. Taxable income is reduced and the tax payable is also consequently reduced down to £37,432. So there is a £7,000 reduction in the tax payable, and on top of that you've got the 20,000 in your pension pot for the future. So there are some areas that you can play around to reinstate the personal allowance, and it's worth talking to an advisor over this. Another form of allowance not mentioned on the previous slide is the blind person's allowance. There's not a great deal we can say about this. It's £2,600 per year. You must be registered as blind or severely sight impaired. And if you think this, you're able to claim this, you can contact HMRC and apply directly for that one. So moving now on to the personal savings allowance. So to the extent that anyone has savings income, bank interest, the first £1,000 of interest received is tax-free if you are a basic rate taxpayer, which broadly means income up to £50,000. If you're a higher rate taxpayer, so between roughly £50,000 and £150,000, you get a personal savings allowance of £500. But once your income goes above 150,000, there's no entitlement to the personal savings allowance. To confuse matters further, there's also a starting rate for savings, and this is a 0% starting rate of tax, and it applies to the first 5,000 of taxable savings income after deducting the personal allowance. This is in addition to the tax-free personal allowance and the personal savings allowance. It's only available to those whose other non-savings income does not exceed £5,000. So once your total savings and non-savings income exceeds £17,570, the starting rate cannot apply. For every £1 of other non-savings income above the personal allowance, the starting rate band is reduced by £1. So As an extreme example, if you only have interest income, you could earn £18,570 completely tax-free by combining the allowances we've just discussed. The next allowance to highlight is the marriage allowance, sometimes called the transferable personal allowance. And this allows someone to transfer some of their personal allowance to their spouse or civil partner if certain conditions are met. You can only transfer £1,260 of the personal allowance, and this equates to 10% of the personal allowance. It has the effect of reducing your partner's tax bill by £251, 1,260 at 20%. It's only available if the person transferring their allowance is a basic rate taxpayer. Person transferring their allowance has income below the personal allowance, £12,570, and their spouse is a basic rate taxpayer up to £50,270. Again, you can apply online for this or via your tax return. Dividend allowance, again, this is very simple. Everyone has a £2,000 dividend allowance, which allows you to receive £2,000 worth of dividends a year, completely tax-free. So if possible, and you're able to structure your income, you should ensure that you take a minimum £2,000 a year, or you would lose this allowance. The last point I have on this slide here is the higher income child benefit charge. So this is not an allowance at all, as the name suggests, but it's a tax charge where child benefit can need to be repaid in certain circumstances. It can be avoided though with a bit of careful planning. So the charge applies if you have adjusted net income of over £50,000 and you or your partner receive child benefit. There's an obvious unfairness in the system. So imagine the circumstances where each spouse earns, say, £49,000 each, £98,000 in total, but because neither of their income exceeds £50,000, they're entitled to child benefit in full. But then think of a separate example. One partner, say, earns £20,000 and the second partner earns £60,000. Their total income is £80,000, £20,000 less, but they're not entitled to any child benefit as well. One of the spouse earns above £60,000. The charge, if it does apply, applies to the higher earner, and the charge is equal to 1% of the amount of the child benefit for every £100 of net income over £50,000. When income hits £60,000, the child benefit is in effect repaid in full. So earlier I used the phrase adjusted net income to describe when the child benefit charge starts to apply. And this means the taxable income before personal allowance, but adjusted for items such as charitable gift aid and pension contributions. And again, this allows for some sensible planning with your income to ensure that you retain your right to child benefit. So looking at the example on the screen here, a fairly standard example, perhaps in this scenario for someone who runs their own company and they're paid the tax efficient small salary of £9,000 with the rest as dividends. In this scenario, they're aiming for £55,000 in income. So the balance taken as dividends is £46,000. In this example, they have 3 children and the child benefit they've received is just over £2,600. As their income is above £50,000, the higher income child benefit charge is relevant. The potential clawback of child benefit is not all of it because it hasn't been withdrawn in total, but potential clawback of £1,318. But what say if they were to make a pension contribution of £4,000, grossed up as before to £5,000. This is deducted from the £55,000 total income, giving adjusted net income of £50,000. and allowing the child benefit to be received in full and no child benefit charge, resulting in a tax saving of £1,318. So again, simple bit of planning allows for tax to be saved in this case. Now over to Nick, who's going to talk through capital gains.
So capital gains tax, I think this is a tax that most people are familiar with. And in simple terms, capital gains tax applies when an asset is sold or gifted away and a gain has been made over the period of ownership. Common assets liable to capital gains tax include stocks and shares portfolios, and properties, second properties that aren't a main residence. And the rates of tax are split according to the type of asset or the type of chargeable asset and the tax position of the person who has made the gain. And for clarity, for a non or basic rate taxpayer who has made a gain on a normal asset like a stocks and shares portfolio, the rate of tax would be 10%, and it would be 20% for a higher rate or additional rate taxpayer. And there is an 8% surcharge for residential property, so second properties or holiday homes, for example, which makes the tax rates for a non-taxpayer or basic rate taxpayer of 18% and 28% for a higher or additional rate taxpayer. But there are allowances, so much like with the personal allowance, every taxpayer is entitled to an annual exempt amount, and that is equal to £12,300 in the current tax year. And that means that where a gain is realised that is below that amount, there is no tax to pay. This provides a planning opportunity because if an individual holds assets that produce gains and are producing gains over a period of time, knowing that you have the ongoing annual allowance, that does provide the option to realise gains on an ongoing basis, perhaps selling a portion of the asset in a given tax year. And if, for example, the amount of gain was £25,000 or £30,000, it would be possible by phasing the sale of the asset over 2 or 3 years to completely eliminate that gain, eliminate it entirely. There are various exemptions that apply with capital gains tax, and one of the most well-known and most useful is that gifts between spouses or civil partners are exempt. And that in itself creates a further planning opportunity because couples can transfer assets that have built up gains between themselves, thereby allowing them to effectively combine their individual exemptions of £12,300 each to produce a couple's allowance of £24,600. And that does allow you to realise significant gains as a couple. And what you could do quite simply is where there is a gain and it's above the annual exempt amount for one of the couple, they could transfer an amount that was suitable to utilise the allowance to their spouse or civil partner. They could both then jointly surrender their share of the asset and neither would have any tax to pay. When that comes to higher rate taxpayers and second properties, the rate 28% is quite a steep rate that can lead to significant savings. It's also useful where one member of a couple has an asset which has grown significantly over a period of time and the two individuals in the couple have got different tax rates. So you can imagine a scenario where a higher rate taxpayer, perhaps they owned a property for many years, a second property that isn't their joint home, and if they were to sell that property, they would be liable to a large gain and a relatively large rate of tax on that gain. Not only could they use the exemption between spouses to transfer a portion of the property into the name of their spouse, thereby allowing them to use both of their exemptions. But there may also be a further planning opportunity to transfer a large portion of that asset or property into the name of their spouse or civil partner if they are a basic rate taxpayer or non-taxpayer and would only pay tax on the excess at 18%, not 28%. And I think capital gains tax really does offer a lot of exemptions. There are also other gains that are exempt from the tax, including gambling wins, the sale of a main residence, which has its own special relief. And for the sake of fullness, it is worth saying that where an individual has actually lived in a second property at some point in the distant past, there are ways in which you can use that part residence as a relief against the overall tax that's due. It is quite a complex calculation, and it would certainly justify the use of a professional advisor. But I think what's clear is that used well, the planning opportunities with capital gains tax can help you save quite a significant amount of money. Moving on now to inheritance tax, which Neal will cover.
Thank you, Nick. So yes, inheritance tax, another extremely complex area of tax. And again, we can't hope to cover all the areas in this presentation, so I'm going to focus on a key few areas that you should be aware of. All shown on the screen here, the nil rate band. This is when someone dies, the total value of their estate is computed, and deducted from that is something called the nil rate band. This is in effect the zero rate band for inheritance tax, and this is currently at £325,000, and it's been that level for many years now. It hasn't increased for a long time. The nil rate band is reduced on the death of a taxpayer by gifts made in the previous 7 years. Any chargeable estate in excess of the nil rate band is taxed at a rate of 40% after any other available reliefs. For a married couple or for civil partners, the amount of the nil rate band not used on the first death can be transferred to the surviving spouse. So in the simplest of scenarios, where on the death of the first spouse, everything is left to the surviving spouse, there is no inheritance tax payable at all, and the surviving spouse inherits their partner's nil rate band, giving them a total available nil rate band of £650,000. There is a second nil rate band, which was introduced a few years ago now, the residence nil rate band. And this is in addition to the main nil rate band, and is where the main family home is passed on to children or lineal descendants, so grandchildren, and is only available in full where the value of the total estate is less than £2 million. Once the estate reaches £2 million, the residence nil rate band is withdrawn by £1 for every £2 over 2 million, so that it is completely gone when the value of the estate is 2.35 million. As with the main nil rate band, any unused residence nil rate band can be transferred to the surviving spouse. So it is possible to have total nil rate bands of £1 million on the second death, the two nil rate bands of 325,000, the two residence nil rate bands of 175,000. So there are clear planning opportunities here to ensure that you keep the residence nil rate bands. So potentially you could look to gift assets away or deplete your estate to remain within the residence nil rate bands. If you can, we can scroll on to the next slide, please. So other gifts, to be aware of, lifetime gifts. Inheritance tax can apply in lifetime just as much as in death, but you have an annual exemption of £3,000. So you can make gifts during lifetime, during each year, of £3,000. And if you haven't used the previous year's annual exemption, you can use that too. but not any years prior to that. So if you don't use those, they are lost. Gifts in excess of this are known as potentially exempt transfer. It's a common misunderstanding that I hear quite a lot, that the total amount you can make in lifetime gifts are £3,000 per year. That's not true. You can gift as much as you like during your lifetime, but anything in excess of the annual exemptions are pets, potentially exempt transfers. If you don't survive 7 years from making a pet, then the pet becomes chargeable on your death. Again, so that there are a number of exempt transfers which are worth bearing in mind and can be utilised in lifetime. As with capital gains, gifts to spouse or to your civil partner are completely free from inheritance tax. Normal expenditure out of income. Now this is quite a complicated one, but imagine a scenario where perhaps you've agreed to pay school fees for your grandchildren. You have quite a large pension, so you've got reasonable income all on your own account, but out of that income, you don't spend it all, you've got an excess. So if you can establish a reasonable pattern of expenditure out of your normal income, that is free from inheritance tax. Other very small exempt transfers to be aware of: small gifts, £250 per year in total to the same person. Marriage gifts, £5,000 if it comes from a parent, £2,500 from a grandparent, £1,000 from anyone else. And gifts to charities or political parties, if you're that way inclined, are also exempt transfers. As I said at the beginning, inheritance tax, incredibly complex, so it's always best to ask or get advice on this. So back to Nick now to talk about investment allowances.
I'm just going to bring things to a conclusion by talking about a couple of relatively well-known but critical allowances that everybody should be at least considering using where possible. Firstly, individual savings accounts, or ISAs as they're known. These have been around for quite a long time now and most people are familiar with them. But just as a recap, these are a type of savings or investment account, and any interest or dividends received and any capital growth that arises within are free of tax. The most common types of ISA are cash ISAs and stocks and shares ISAs. And the maximum amount that you can pay into these types of ISAs is £20,000 each year. You can pay into more than one type of ISA each year, for example, splitting £10,000 into a cash ISA and £10,000 into a stocks and shares ISA, but you are limited to being able to only contribute into one of each type of ISA in any given tax year. There is also such a thing as a lifetime ISA, which is a relatively new innovation, and this is designed to be used to save for retirement, but also to be used towards the purchase of a first home, which is perhaps the reason why most people who use it have taken it out. It can be opened by somebody between the ages of 18 and 39, and up to £4,000 a year can be paid in, with the state adding a bonus of 25% of the amount paid in, i.e. up to £1,000, thereby allowing somebody to accrue a maximum £5,000 a year. There are some drawbacks though with the lifetime ISA, which is why it has been only semi-popular. If anybody wishes to withdraw their funds from the lifetime ISA prior to reaching the age of 60, which is when the access is enabled, there is a penalty which actually wipes out the benefit of the bonus that is being paid in, and the only time that the bonus can be retained is if that ISA is used towards the purchase of a first property. But because of that very, very useful advantage, the lifetime ISA has been growing in popularity, and a lot of younger people are using it in place of the now closed options like the Help to Buy ISA. There is also the option of a junior ISA, which is for, as the name suggests, younger people. And again, this allows for younger people to accrue savings or investments in a tax-advantaged environment. Some of the drawbacks of this are that the younger person can gain access at 16 and withdraw the funds at 18. But it is a useful product for those people looking to save for their children. The ISA is effectively an onshore tax haven. There aren't many opportunities within our tax system for people to put money away and to completely ring fence it from tax. It does seem to have cross-party support, and so it does look as though that ISA allowance will be maintained well into the future. And it's normally one of, if not the first port of call when a client comes to us with money to invest, or with questions around where they can put money if they're investing for the future. However, equally useful and perhaps even more advantageous, depending on circumstances, is pensions. And as Neal has shown, personal pension contributions are eligible for tax relief at the taxpayer's highest marginal rate. And what that means currently is that if the person is a basic rate taxpayer, they get 20% tax relief. If they're a higher rate taxpayer, they get 40% tax relief and 45% tax relief if they are an additional rate taxpayer. The mechanism is fairly simple, as Neal explained, in that you get 20% tax relief at source, i.e. the pension company reclaims that from HMRC on your behalf. And for a higher rate or additional rate taxpayer, the additional tax relief is reclaimed via your self-assessment at the end of the tax year. But as you can see, the benefits are significant. You can, if you were to put £16,000 into a pension as a basic rate taxpayer, that's grossed up to £20,000. The great advantage of pensions like ISAs is that any interest or dividends received or capital growth that arises is completely tax-free within the pension, which means it grows gross of any taxes. And when you come to draw your pension, you'll receive 25%, in most circumstances, 25% tax-free, with the balance being taxable at your marginal rate. So as though you're earning that money. So basic rate might apply, or higher rate if you're making larger withdrawals. This makes pensions really an incredible vehicle for accumulating wealth over the longer term. And when it comes to deciding which is right for you, it really does depend on your circumstances, but both have great advantages and great benefits depending on what your ultimate goal actually is. There are some limits to what you can pay into a pension and what you can ultimately accumulate in a pension, with various taxes being payable along the way, including annual allowance tax charges if you pay too much in a given year, or lifetime allowance tax charges if you accumulate too much in your pension over your lifetime. It's beyond the scope of this webinar to go into those in too much detail, but for most people, their pension contributions will be limited to what they earn in a given year, in that you can't normally pay more into your pension than your salary that's paid to you actually is. And when it comes to lifetime allowance, the current allowance is a smidge over £1 million, which for a lot of people, if they start saving very young and they stick to a regular contribution strategy, is not necessarily out of the realms of possibility. So it's very important when paying into a pension or drawing from a pension that you consider taking advice, because there are ways of maximising your tax position and there are ways of doing the opposite. So we certainly recommend taking advice when it comes to any serious pension planning. Now that concludes the webinar. I think what we're going to do is just run through and see if there have been any questions, and I will either field those myself, or perhaps invite Neal to have a look at them as well. One of the questions I think is probably suitable for you, Neal, given you touched on inheritance tax, is regarding lifetime gifts. And the question is, do I need to keep a record of lifetime gifts? And how would I generally go about doing this? And I think that probably refers to the pets you talked about. How would you answer that?
Absolutely right. So yes, you have to keep a record of lifetime gifts, and keep that information somewhere safe, and let the people who are going to be dealing with your inheritance tax return know where that information is. Otherwise, on your demise, they're left looking through bank statements trying to ascertain what gifts have been made, and it's a very difficult task. So if you can keep a record of what gifts have been made and let your family know where that information is, that makes life a lot easier. Also, in terms of when we discussed regular gifts out of income, it's a great relief that's available, but when you submit the information on that to HM Revenue and Customs, they ask for a lot of detail on what your income is, to check whether you're gifting your excess income, and the amounts that's been gifted over the years. And this goes back 7 years, so you need to have full and detailed records. It's very difficult to put together if that information is not readily available. Hope that answers the question.
Brilliant, I think. Thank you, Neal. There is another one which I'm going to ask you to answer as well. I think it's probably a good one for you. And it's a question from somebody who has children and says that the children have investments in their name. And effectively, the question itself is whether children have the same allowances as adults and how that works.
Yes, absolutely. So, yes, children have identical allowances to their parents, or to adults. So they have the tax-free personal allowance, just like an adult would. They have the capital gains tax exemption, just as an adult would. So this can allow for planning. You can, if you can find a way of getting income into a child's hands, then it can easily be tax-free. One slight caveat I'd put on that is, if the income producing asset came from you, their parents, and the income produced is over £100 per annum, that income will be assessed on you under an area of tax law called settlements legislation. But perhaps if the assets came from a grandparent, that rule doesn't apply. So yes, children have allowances, and you should look to make use of them if you can.
Brilliant, thank you. One of the questions that I have just seen crop up is regarding whether it's more efficient to save into an ISA or into a workplace pension. I did kind of touch upon this, and I think this is one of the kind of questions where I'll generally refrain from giving too clear of an answer because of how important it is to start with the end in sight, i.e. the goals of the individual in question. There are some clear advantages to a pension in terms of the tax relief. When you pay into an ISA, that money has generally been earned and taxed, whereas when you pay into a pension, the effect of the tax relief is that money is effectively received by you without paying any tax on it, and that means that a pound paid into an ISA is generally equivalent to £1.25 going into a pension. However, the restrictions on drawing upon an ISA are much less restrictive than drawing from a pension. So those people that do want to access their money before retirement, and the current age of access, we know it's changing to 57 very soon, and it's quite likely to continue to move in lockstep with the state pension age, and we're expecting it to increase perhaps to 68 and then 69 in time. Therefore, accessing your pension would be 58 and 59 and possibly 60. So the restrictions are the price you pay for the tax advantage of a pension. So I think to answer the question, what I would say is that it really does depend on what the goal for the for the investment actually is. We would always use a bit of a cliche in that we don't let the tax tail wag the dog. The tax advantage of an investment is an advantage rather than a reason to use that particular product. So it would very much depend on the situation of the person in question, and would require a deeper analysis of the person's situation. There is one more unanswered, and Neil, I'm going to run this one past you as it is relatively complicated. Might be an easy one to answer though for you. And the question is UK tax due on dividends in a general investment account above £2,000 for, say, United States stocks when tax is already paid to the American authorities?
Okay. So much would depend on the tax status of the individual here, but for simplicity, assume we're talking about a UK resident, UK domiciled person, just with US investments perhaps. A UK res, UK dom person is taxed on their worldwide income. So yes, there would be tax would be due in the UK on not just US, but any foreign dividends received. And those foreign dividends can form part of the £2,000 allowance, absolutely. If tax is paid in the US, which would normally be the case, there would normally be a 15% withholding on US stocks. That is, in most circumstances, deductible from any UK tax liability. So I hope that answers the question. Yes, it is taxable in the UK, but you would get credit for American tax paid.
Brilliant. Thank you, Neil. That concludes the questions. If there are any that come through in the next minute or two, we will look to answer those. But I think that probably concludes the webinar. Thank you very much for everybody who's attended. Hopefully it proved useful. If you do have any questions, you will be forwarded our contact details and a link to a copy of the recording over the course of the next week or so. Please do feel free to get in touch. Hopefully there will be, you will have found some of the content useful for your own purposes. And we look forward to hosting you and seeing you at future webinars. And thank you very much, Neil, for joining us for the webinar. Very much appreciated.
Thank you very much, and I hope everyone found it useful. Thank you. Goodbye.